Welcome to PhillipCapital Weekly Market Watch. I'm Camelia, Business Development Dealer from Phillip Futures. For this week's episode of Market Watch, I'll be talking about crude oil prices, focusing on WTI. Crude oil prices have rallied since November last year and are currently trading at a high since mid-2015, where the WTI is trading range-bound at about $50 to $54 per barrel. However, if we look at the chart, the RSI is inching towards an overbought signal and the MACD is losing steam of a further bull run. This range could potentially be the cap for oil prices in the short term. There are some key factors which might potentially reverse the current trend and cause oil prices to stay low and trade below $50 per barrel. Crude oil prices are mainly driven by the fundamental factor of supply and demand. Current situation of oversupply is keeping crude oil prices under pressure, where the US crude inventories are still near record high of about 1.2 billion barrels, and the EIA is expecting the global crude inventory build to continue but at a slower pace this year. Inventory builds are forecasted at an average of 0.3 million barrels per day this year as compared to an average build of 0.9 million barrels per day last year. The latest weekly US crude inventory figures also showed that inventories grew by an unexpected 6.5 million barrels, which far exceeded analysts' expectation of an increase of 3.3 million barrels. Looking at the world supply and demand chart, the market is still currently facing a global glut and the oversupply issues is projected to continue through 2017. This will potentially cap further upside gains to crude oil prices. Furthermore, the OPEC and non-OPEC countries' joint efforts of production cuts in the first half of 2017 to rebalance the oil market might be overpowered by countries that did not join in the effort, as they are potentially increasing production in the coming months. Although the joint efforts have achieved 82% compliance with its promised production cuts of 1.8 million barrels per day, the rebalancing might have been held back by evidence of higher US oil drilling activity and potential rebound in shale production. According to EIA, we have seen months of increased drilling in the US, and the US oil production has increased by 6.3% since July last year to a high of almost 9 million barrels per day. Other than the US, the EIA also expects crude oil production to increase in countries not covered by the agreement, like Nigeria and Libya, where previously restricted oil fields continue to see increased production. The potential production increase from the US, Libya and Nigeria in the coming months is expected to result in an increase in global oil supplies and could delay the timeline of an oil market rebalancing. To add on, uncertainties still remain as to the effectiveness and duration of the current OPEC and non-OPEC production cut, which could put downward pressure on prices if major producers like Saudi Arabia were to increase crude oil production going into the summer months to satisfy domestic demand for crude oil. Last but not least, Donald Trump's pro-oil policies to advance construction of the 2 oil pipeline projects could potentially increase crude production by 1 million barrels per day or more. These policies could impact market sentiments and affect crude prices negatively. Therefore, in conclusion, given the current supply over demand situation and the potential increase in global crude supplies from non-participating countries, especially from the US, and Trump's pro-oil policies, we expect crude oil prices to stay low and trade range-bound between $45 to $55 per barrel in the short term. With this, we have come to the end of this week's Market Watch. For more information on how to get started investing in crude oil market, please feel free to approach any representative from Phillip Futures. Please subscribe to us on PhillipCapital YouTube channel and Facebook and stay tuned for more Market Watch videos. Thank you.